Guys, ano-ano ba ang inyong mga batayan sa pagpili ng kung anong stocks ang inyong bibilhin? In this video, i-discuss natin kung ano-ano dapat yung maging basehan natin sa pagpili ng stocks. And this will help us take advantage and profit from undervalued stocks. Kaya, watch this video. Hello guys! My name is Peter and welcome to our YouTube channel. Our YouTube channel provides free learning videos regarding the stock market to guide newbies and investors, to shorten your learning curve, and to maximize your profits with your investments. Kaya if you are new in our channel, make sure to hit that subscribe button and bell notification para lagi kang updated sa mga new content na ating ina-upload. Ayun! So ngayon nga guys, pag-uusapan natin itong 5 must-have metrics for value investors. So these key metrics, when properly understood and applied, will help investors profit from undervalued stocks. So ano-ano ang mga yun? Una is yung price to earnings ratio. Ikalawa is yung price to book ratio. Ikatlo is yung debt to equity ratio. Ikaapat, free cash flow. And ikalima is yung PEG ratio. And before the end of this video, ipapakita ko rin sa inyo kung saan natin ito pwedeng hanapin para mas madali tayong makapamili ng mga stocks na gusto natin bilhin. Unahin na natin guys, discuss itong price to earnings ratio or yung PE ratio. PE ratio is the ratio between the price relative to its earnings per share. If company ABC, for example, has an earnings per share of 10 pesos, then the current market price is 100 pesos, that means its PE ratio is equal to 100 divided by 10, which will give us 10. So, what does this value signifies? Or ano yung importance ng PE ratio? So, dito sa ating example, since ang PE ratio ni company ABC is 10, means that if you are the buyer of company ABC and the PE ratio is 10, na you are willing to pay 10 pesos for every 1 peso earning ni company ABC. So to have a comparison, if company B has a PE ratio of 5 and company C has a PE ratio of 35, alin sa tatlo ang stocks na cheaper? So syempre, si company B na merong PE ratio na 5. Kasi you only have to pay 5 pesos for every peso na earning ni company B. So yun ang kahalagahan ng PE ratio na dapat nating maintindihan. And as a general rule, if the PE ratio is less than 10, we consider that stock as undervalued. Whereas, if the PE ratio is greater than 20, we consider that stock as overvalued. And anything in between is considered fairly valued. Mamaya, papakita ko din sa inyo kung saan natin makikita itong mga PE ratio para mas madali tayong makagawa ng guide kung anong mga kumpanya ang undervalued at kung ano ang mga overvalued. Ngayon naman guys, let us discuss the price to book ratio. So the price to book ratio is equal to the price divided by its book value per share. By the way, PB ratio and PE ratio are both valuation method na ginagamit natin to determine whether a company is undervalued or overvalued. Ang difference lang, kay PE ratio, we use earnings per share as a basis. Kay PB ratio naman, we use the book value per share. Pero, by looking at their figures, we can determine whether a company is undervalued or overvalued. Okay, going back to price to book ratio. Yung book value dito, book value, that is equal to the total asset of the company minus the total liabilities. So compute mo lang, add all the total assets ng company minus the liabilities, then you will get the book value. Then divide mo this value by its outstanding shares, you will get the book value per share. Okay, for example, if company ABC has a book value per share of 10, then its current price is 20, then we will get a PB ratio which is equal to 20 divided by 10. We will get 2 as the price to book ratio. That means that you are willing to pay 2 pesos for every 1 peso na net worth ni company ABC. So yun yung kanyang significance. Just for comparison, if say for example, company B has a price to book ratio na 5 and company C has a price to book ratio na 4. Alin ngayon sa tatlong kumpanyang ito, company ABC, company B, at company C, tayo mas makakamura kapag binili natin yung kanilang shares? Is it 2? Is it 0.5? Or is it at 4? So alin sa tatlong kumpanya na to, company ABC, company B, at company C, tayo mas makakamura kapag binili natin yung kanilang shares of stock? So, syempre, mas makakamura tayo kay company B. Kasi, it means that we are only paying 50 cents for every 1 peso na net worth ni company B. Whereas, kung bibili natin itong company C, we are paying 4 pesos for every peso na net worth ni company C. Ganon din kay company ABC. If that is 2, then we are paying 2 pesos for every peso na net worth ni company ABC. And generally, if the PB ratio is less than 1, then that company is considered undervalued. But if it is more than 1, it is considered overvalued. So ngayon naman, let us discuss the debt to equity ratio. Debt to equity ratio, by the name itself, is the total debt of the company divided by the total equity of the company. Debt means yung utang ng kumpanya. And yung equity, yan yung pera, the total money ng mga shareholders na in-invest nila in that particular company. Okay, for example, if company ABC has a total debt of 2 billion pesos and a total equity of 1 billion pesos, that means that company ABC, has a debt to equity ratio equal to 2 divided by 1, which is 2. So ngayon, what these numbers tells us naman? Dito kasi sa debt to equity ratio, mo makikita kung saan kinukuha ng isang kumpanya ang perang ginagamit nila for their expansion and their capital expenditure. If a company has a debt to equity ratio na 2, it only means na twice as much yung kanilang utang compared sa shareholders' equity. And we know for a fact na kapag mas malaki yung utang ng kumpanya, ay mas malaki din yung risk. Kaya kung mapapansin nyo guys, yung mga kumpanya na malaki ang kanilang debt to equity ratio, ay yung mga kumpanya hindi ganong tumataas ang kanilang market price. If the debt to equity ratio is less than 1, that only shows that a company prefer to offer additional shares sa public kesa sa mangutang sa mga bangko or financing institution. Okay, ngayon naman, let's talk about the free cash flow. Ang free cash flow, simple lang naman guys. It is the net cash of the company minus the operating expenses and the capital expenditure. So madaling sabi, yan yung pera ng kumpanya na hawak nila na pwede nilang gamitin at their own will. So the higher the free cash flow the company has, the better for the company. Kasi may pera silang magagamit kung saan nila gusto. Pwede kasi nila itong gamitin for expansion. Pwede din niyang pambabayad ng mga dividends at pwede din i-reinvest nila through shares buyback. Kaya kung pipili kayo guys ng kumpanya na bibilhin, make sure that they have a good or higher free cash flow. Okay, ngayon naman guys, let us go to our number 5 ratio, which is the PEG ratio. PEG ratio is equal to the price to earnings ratio divided by the earnings growth of the company. So, usually sa Pilipinas, nakita ko, they are computing it based on 1-year growth. Ngayon, as an example, if company ABC has a PE ratio of 10, then an earnings growth of 20%, then that will give him or that company a PEG ratio of 0.5. So ano importance ngayon itong value na to? Analysts say that it is more accurate to use PEG ratio as a valuation method compared to the PE ratio because it already accounts the earnings growth. So, medyo malabo, ano? Let me give you an example. We have here company A and company B. Si company A, meron siyang price to earnings ratio na 10. Si company B naman, meron siyang price to earnings ratio na 20. Okay, by just looking at the price to earnings ratio, you most probably will think that company A is undervalued compared to company B. Right? Do I make sense? Kasi ang PE ratio ni company A is 10 eh. And ang PE ratio ni company B, 20. Mas mababa syempre yung 10. So we might conclude na company A is undervalued or compared to company B. But if we take into consideration the earnings growth of the company, then we will have a different picture. Okay, if company A has an earnings growth of 10% and company B has an earnings growth of 30%, so what would be the PEG ratio of both companies? For company A, the PEG ratio will be 10 divided by 10, that is 1. For company B naman, PEG ratio will be 20 divided by 30, which will give us 0.67. And generally, if the PEG ratio is less than 1, then the market considers that that company is undervalued. And if it is greater than 1, the market considers it as overvalued. So ngayon, upon considering the earnings growth of company A and earnings growth of company B, we then conclude that company B is more undervalued compared to company A if we consider the PEG ratio. For me, PEG ratio is better than the price to earnings alone. Kasi nga naman, if the company is growing fast year by year, like for example 30% a year, then its valuation will also increase higher compared to those companies na nag-grow lang ng mga 5 to 10%. So ngayon naman guys, para malaman kung saan natin makikita yung mga ratios na diniscuss natin, punta lang man tayo sa ating broker. So ngayon, punta tayo kay Call Financial. Then under dito sa mga menus niya, i-click lang natin itong quotes. Then yung stock. Then type natin dito yung kumpanya na gusto nating tingnan. So halimbawa ito si Mega World. Since nandyan na siya. Mega World Corporation. Then click natin yung kanyang valuations. At makikita ninyo guys dito, meron siyang price to earnings ratio from 2015 to 2019. So ito yung mga values niya. So base sa ating na-discuss, if it is less than 10, it is considered undervalued. Just remember lang guys na itong computation nila dito is based on the year-end price of each year. Halimbawa, itong 2019 na price to earnings ratio niya na 7.21 is computed based on the year-end price noong 2019 na 4.01 divide mo by 0.56 which is the earnings per share. Then, andito na rin sa valuation ni Call, yung ating price to book value. Ayan, makikita nyo dito. And as per our discussion, if the book value is less than 1, that is considered undervalued. If it is more than 1, it is overvalued. Ngayon, andito din yung ating free cash flow for the past 5 years. Then, ang maganda pa, andito yung kanilang price to free cash flow, which is also a good metric na magagamit natin in valuing a company. Then, nandito na rin guys itong PEG ratio. So, hindi na talaga kayo mahirapan mag-compute pa ng mga ratios na to kasi it is already provided by our broker. So, i-analyze na lang natin yung mga data na binibigay sa atin. So, based sa ating discussion, once ang PEG ratio is more than 1, that is considered overvalued. But if it is less than 1, that is considered undervalued. So, ang wala lang dito talaga is yung debt to equity. Hindi ko siya mahanap. Pero we can also compute for that. Kung pupunta tayo sa PSE Edge, then i-divide lang natin yung kanilang debt over their equities. Then we will get the debt to equity ratio. So that's it for today's video guys. I hope meron kayong natutuhan sa mga shinare ko ngayong araw. And if you like this video, pakishare naman po sa inyong mga kakilala, kaibigan, para mas maraming Pilipino ang matutong mag-invest sa stock market at magkaroon ng passive income. It is really my desire na makatulong sa mas maraming Pilipino sa kanilang pag-i-invest. Thank you for watching. See you in the next video. God bless.